Okay, so our next thing to look at is our depreciation from the date of purchase until the date of sale. So if you look at the wording here, okay, they're coming along and they're saying to us in this particular question that we have a delivery van and it's disposed of and we get a new van and all the rest. But our policy here is 15% of cost from the date of purchase to the date of sale. So it's really important that we count the months properly here. So it's the same as any disposal working. You're going to have your 6 steps as normal. So we're going to set that up first. Okay, so we're opening our T accounts for this. So the exact same process as we always do. So we come along and we're going to have our asset account here. It happens to be a delivery van, but it could be for any asset. And we know that at this stage. So we have our asset account, our depreciation account, our disposal account. Remember, our step 4 here is going to be our depreciation on disposal. So on the asset that we're after disposing of. Down here we'll have our depreciation for the year. And then normally what happens is the check for our new asset is treated incorrectly as a purchase of trading stock. Now remember, they could change that at any stage. So what we're focusing on here though is our depreciation and what we have to do. So our delivery vans account is an asset. Put in your plus, put in your minus. Your depreciation. Remember, treat it like a liability because it's going to reduce an asset. It's not strictly a liability, but we know what's happening there, how we're going to treat that. And then we have our disposal account. So you remember your disposal is going to be here. And we're going to figure out if we made a profit or a loss by getting rid of this asset. So the first thing you're going to do is put in that opening balance from your delivery vans account. So you're back to here. Make sure I'm using the right question, sorry. So your opening balance there, 175,000. What I would do then is I'd open my depreciation account as well. Opening balance there, remember how you're going to do that. You're going to come back and you're going to say your 175,000 minus the 135, the net book value. So there was 40,000 depreciation at the start of this year. So now you're ready to fill this in, okay? So your disposal. So for anyone who's doing a straight line, you know when you do those one line working straight across, you're subtracting your disposal figure here. Okay, so our disposal, a delivery van which had cost us 36,000. So that is your disposal there, 36 coming out. Now what did we get instead of it? So we got a trade-in or we got an allowance, okay, the same thing. And then we have a bank figure here. So how much was the trade-in or allowance? So we can see 18,000 was the allowance that was given. So we're just marking that in, okay, 18,000. So that's where you would add on the 18,000 and then your check. So how much of a check did you have to write? So the new van costs 45, so you're going to come along and it's going to be your 45,000 minus the allowance of 18 that you got. So that's the bank for 27. And remember, that's going to be subtracted from your purchases. Should never have been treated as a purchase of trading stock. So you can see it there subtracted. So now you're ready to get your balance carried down on your delivery vans. So the 175 plus the 18 plus the 27 minus the 36. So 184, that's going to be a tangible fixed asset. So you would mark that off straight away. Tangible fixed asset. Now this part here, okay, you know there's going to be the P&L, the charge for the year. You know you're going to have your disposal figure here. And then you're going to have your balance carried down. So let's look at this, depreciation on disposal then. So how do we actually calculate that? So this delivery van cost us 36,000 on the 30th of the 6th, 2019. So for 2019, what's happening here? Okay, so we're coming along, we got it on the 30th of the 6th. So 6 months had passed, so we had it for the 7th, the 8th, the 9th, the 10th, the 11th and the 12th. So we had it for 6 months in 2019. We had it for all of 2020, all of 2021, and then 2022. We got rid of the asset, okay? So what date in 2022? The 30th of the 4th. So 4 months had passed at that stage. So in 2022, we only have that asset for 4 months. And that's the key thing there, that you get the months correct there. So we have our 6 plus 24 plus our 4. So 34 months in total. That's how long we kept this asset for. So what we do is we take the cost of the asset, 36,000, at our rate of depreciation, which is 15%. Remember, that was given to us at the start of this working, multiplied by 34 over 12. So you're coming along then and you're working out what your figure is. So that's the amount of depreciation that had been written off this asset. So that's your disposal figure. So the 15,300 goes in there. The next thing you're going to do is calculate your depreciation for the year. So for the depreciation for the year, think of it this way. At the start of the year, everything was fine. We're looking at 175,000. That was your opening balance. So 175,000. Now, how long did it stay at 175,000 is what you have to ask yourself. So 15% being charged, and that was for the first 4 months, because remember, nothing happened until the 30th of the 4th. So you had it for the first 4 months, so multiplied by 4 over 12. And that's going to give you the first part of our depreciation for the year. 4 over 12. Then for the remainder of the year, you had gotten rid of the 36,000, but you got in a new asset costing 45. So it's now up to 184,000. At 15%, how many months did you have it for the remainder of the year? So that was for the remaining 8 months of the year. So you're coming along, 184,000 at 15%, multiplied by 8 over 12. So you now have your total there. So as you come along, you're going to have your total coming in. So your 184 plus the 8750. So 27150, and that's going to go in as your charge for the year. So 27150. And again, you're looking for your balancing figure here. So the 27150 plus the 40,000 minus the 15.3. Now, that's a figure we've just worked out. So I'm just highlighted in yellow. That's your accumulated depreciation. That's going to be your selling and distribution. And then work out if you made a profit or a loss by getting rid of this asset. So remember, you cross-post in. So from your delivery vans, 36,000 going in there. From your depreciation account, 15,300 going in. And then you got a trade in or you got an allowance, same thing, okay? And that was 18,000. So you check, did you make a profit or a loss on this? All right, so the credit side there only totaling to 33,300, so there is a loss. So your P&L transferring a loss in at the end of the year, your 36,000 minus the 18 and the 15.3. So a loss there of 2,700, and that's selling and distribution. So if I were you, I would be thinking, right, from this disposal adjustment, there's going to be 4 figures. Your cost figure for your tangible fixed asset, your accumulated depreciation figure, your charge for the year, so that's your selling and distribution, and then if there's a profit or a loss. So a loss is going to go into selling and distribution because it's delivery vans. If it was a profit, it would be operating income, and then your purchases figure. Okay, so 6 steps in it, and generally speaking, we're taking 4 figures directly from it, and then we have to adjust the purchases. It's normally the purchases that they say the check for the net amount was incorrectly treated as a purchase of trading stock. But remember, they could change that, okay? But the key thing here is the months, that you're counting the months, all right? So just keep an eye on that as you're going through it and make sure you're happy enough with the adjustment on it, okay?